Also happening, Jerome Powell making his first trip to Capitol Hill tomorrow as Federal Reserve Chairman. He's testifying on the U.S. economy and the outlook for interest rates. Interest rates are powerful words these days. They are affecting equity prices. Art Hogan, Chief Market Strategist at B. Riley FBR, joins us now. Hey, Art.
Hey, Lauren.
You know, Jay Powell, we finally get to hear from him starting tomorrow. You know, is he going to sound like Janet Yellen, or is he going to sound like Jay Powell?
It's going to sound like Jay Powell. Now, remember, about a month and a half ago, we actually got to see him before Congress in his confirmation hearing. So this will be round two. This is probably going to be a lot more of the same, right? So he's going to get up and say, here's how we feel. Here's where we stand right now in the economy. We think we're seeing gradual economic growth that's improving. We're at full employment. And we think inflation is going to reach our target sometime the next year or two. So therefore, we're going to gradually raise rates and normalize rates. I think that's the best case scenario. I don't think he's going to try to hit any home runs or any balls out of bounds. I think the Q&A will be frustrating for him because this is the time for showcase. You know, if I'm a senator now, I can ask you about things that have nothing to do with your job. You know, what about too big to fail? You know, what about global warming? And, you know, all the things. It's a time for me to sort of play up to my constituents. But in terms of what he has to say, I don't think it'll be market moving necessarily. I think he's going to really try to keep the ball in the middle of the fairway.
All right. And for investors, interest rates are key. What's the line in the sand for you? What interest rate do you think will totally spook the markets? And I asked that in the backdrop of a Goldman Sachs report that essentially said equity prices could plunge 25% if the 10-year yield hits 4.5%. So a 25% correction. Let's say the S&P 500 is at, what, 2,700 and change. Now we're talking about S&P 2,200. Do we go to S&P 2,200 if we have a 4.5 10-year yield?
Yeah, you know, that's their worst case scenario. I think that's really a stress test level.
Okay.
I certainly don't see us getting to 4.5%. I think their base case and our base case is the same thing. We're about 3.25, 3.5. They're about 3.25. I think the markets can handle a 100 basis point move. That would be a 100 basis point move in a year. They just can't handle it in a month. And I think the reason that the markets sort of sold off and had that 10% correction is we actually went up about 30 basis points in about 5 trading days. So it's the pace at which you get to where you're going, not the ultimate, you know, there is no line in the sand. 3% doesn't really mean anything to the equities markets. You know, yes, at 4.5 by the end of this year, that would certainly be disruptive. I don't think we're getting anywhere close to that. I think this market can handle 3.25, 3.5. If we gradually continue to do that for the balance this year, we'll be fine.
Okay, so 3.5 is what I heard there. So you're sticking with 3 rate hikes for this year, or maybe potentially 4 or 2?
We're at 3. I think 3 rate hikes. I think 4 is kind of too many. But, you know, as they say, rate hikes are like martinis. After 3, you just don't care. I think it's going to be the same thing. 3 is probably going to be exactly where we are. And I think with economic data and everything, I mean, it's just we don't see enough inflation to get to 4. I think that's
for me, it's 2 martinis. I'm a cheap date, Art.
All right.